Yeah, sentiment is really a key indicator that we look at, trying to determine whether we're at an extreme in optimism or extreme in pessimism or somewhere in between. I think just talking to people that I talk to, whether professionally or just friends, there's kind of a complacency out there right now because people aren't sure what to do. They really haven't had this situation in the market for a number of years. And for a lot of people I know, it's been 10, 15 years before or since the last real significant downturn. And one of the lessons I think that they think they've learned is that if you just hang on and don't do anything, eventually the market will come back. And at the largest degree of trend, that's true. Over a long period of time, the United States isn't going away, but no one ever defines what the long term is. And I've been talking to friends about that, and they said, well, maybe 3 to 5 years, if I just kind of hang on to my retirement, it looks really bad right now, my portfolio. I really don't look at my statements, but in 3 to 5 years, we'll probably stabilize and be on our way back to new all-time highs. So one of the things that I want to impart upon our subscribers and our readers is a lot of people don't understand just how big this bear market's going to be. It's a tough thing to get your mind around because we've never lived through a grand supercycle bear market before. This is grand supercycle wave 4 in Elliott wave terminology, and it's the biggest bear market we're going to have in our entire lifetime. And stocks are going to go down much farther than people think. And portfolios and retirement plans are just going to get, more than halved as the market keeps going down and down. And it's tough to convey that to people because if you've never experienced it in your life and you've never lived it, it's tough to grasp that concept. So one of the things that I think we'll be doing in our newsletter as we go forward and as I talk to people and is just to try to give them a sense of just how big this decline is eventually going to be in the market. Right, so as you start down into a bear market, this kind of complacency takes over to begin with. But what happens in terms of Elliott waves is once you get past that midpoint, which we call the third of the third wave, that's when that complacency turns to a realization that, wait a minute, things are really bad and we're really in a bear market and the market's going down. And that's when you start seeing some panic enter some of the indicators we look at. And I think sentiment goes from complacency to concern to panic. And we're not there yet. We're not even close to that midpoint yet. So it's something we're watching, and as we look at the market unfold here, I think people have to just be cognizant of where we are within the progression of the pattern. We'll be talking about this, and again, just how big this decline is eventually going to be. It's going to really rock people's lives, not only their portfolios. And so one of the things that we do is try to help them remove themselves from that emotion, help them look at what's going on analytically, and hopefully remove them from where they're going to get hurt financially. And if you can do that and be on the sidelines, I think you're able to be much more calm, understand the emotions that are happening, divorce yourselves from those emotions, and then be ready when the time comes to step back in and pick up stuff that's going to be very, very cheap. Right, the point of recognition is the middle of a third wave within an impulse pattern, and that's still a long ways off. One of the things that we look at, we look at all markets and whatever's going on in, say, cryptocurrencies or regular currencies, and particularly in the credit markets and the bond markets. And that's something that I look at every single day because the credit markets kind of have a way of snuffing out impending trouble in the stock market. And right now, the Bloomberg Global Aggregate Credit Market, which or credit index, which is comprised of, I think it's 28,000 issues with a market value of $60 trillion. It's huge. It's down over 15% this year so far, which is by far the worst return to start a year in the history of the bond market. So we're looking at credit markets that are telling us there's problems coming not only in the stock market, but the broader economy. And you couple that with the fact that we had New York Stock Exchange margin debt, which was at by far an all-time record high of over $900 billion last October, as the broad market was peaking out in November, which was more than double the margin debt that occurred at the 2007 high right before the Great Credit Crisis. So you had a doubling of margin debt, basically, and that debt has to be worked off. That has to be, as the market goes down, these margin clerks are going to start calling, and you're going to get these margin calls from people who are over-leveraged. So I think that the decline in the bond market, the over-leverage in the stock market is going to lead us to some sort of blow-up somewhere. And when I say blow-up, I mean hedge funds or institutions or somebody very large is going to be over-leveraged and caught in a position that they can't get out of. And I think that sort of thing happens around a third of a third. We kind of know the psychology as we progress within the Elliott wave structure. And that's kind of a fundamental thing that's going to probably pop up in the news as we get closer to that third of third, and as the market keeps working its way to the downside. Right, so how do people prepare for this environment? And it's something that I said in the last time that we talked to you, and that is safety. It's the concept of safety. Right now, just being in a simple money market fund at a bank is giving you a better return than if you were invested in stocks, because stocks are down. The Nasdaq's down 30%, the S&P's down 20%, and you're getting what? Maybe 1 or 2% at the bank, or 1 or 2% in a CD, or 2 or 3% in some short-term investment. But that's a better return than you are in the stock market. So our overarching advice, general advice to people is, in this environment, be safe. And whatever safety means to you, that's what you need to do. Whether it's, short-term treasury bills or CDs or safe banks. You have to, a lot of banks are going to come under pressure here. So you have to kind of ferret out the safe ones that have a good capital structure. But whatever safety means to you, that's really what you want to maximize in a bear market environment, and particularly in a grand super cycle bear market environment. Because again, I don't think people really can grasp how far down the stock market is going to travel over the next several years. We're in a bear market, and bear markets are tricky. And the reason they're tricky is because you get these huge, sharp counter-trend rallies within an overall downtrend. And it's very difficult to divorce yourself emotionally when you look at these huge rallies and you say, the bear market must be over. After the 1973 peak, when the Dow peaked in January 1973, I think the market was still within 6 or 7% of the all-time high by October of 73, 10 months later. And then from October of 73 to December of 74, it just fell out of bed, 40% decline, and everything just got flushed out. And if you think back after the peak in October of 2007, at the forefront of the Great Credit Crisis, I think the Dow was still within 7 or 8% of the all-time high by May of that following year. And then from May of 2008, over the next 10 months, it got crushed. It fell well over 40% again. And so we're going to get these sharp rallies along the way. And you have to expect that. But I think the wave principle gives us a pretty good idea of when the end of the bear market will be. And so we'll be talking about that in all of our publications. But I just want people to be aware that you're going to get these big gyrations, but the trend as we see it and in our analysis is far from ending. Learn, read, listen to what we have to say, incorporate that in what you're doing. Maybe there's something we talk about that will pique your interest, that will drive you to investigate something a little bit differently or a little bit deeper. And before you commit any money to anything, and this is just a general recommendation, is just to learn as much as you possibly can. And so part of what we do in the letter is not only talk about forecasts in the market, but we try to do some teaching too. And we look at things socioeconomically, and hopefully if we can orient people from a socioeconomic perspective and looking at psychology and herding, that will give them a little edge. I mean, to be successful in an investor, you don't have to be perfect, because there is no perfect, but you just have to have a little edge over everyone else. And that little edge, in our opinion, is the wave principle and socioeconomics, and it gives investors a perspective, I think, that puts them ahead of the crowd, and they're able to detach themselves from kind of the motions of the moment. Yeah, so there's one great resource, and of course I'm biased, but I think that resource is Elliott Wave International. If you go to elliottwave.com, we've got a ton of free material on the website, a course on what is Elliott waves, how to apply them, and I think this is the key resource in an environment that is going to be very challenging and very difficult, not only investments but individually and emotionally, as we look around, because bear markets carry with them certain societal challenges, if you will, polarization, anger, things like this. And so you have to kind of learn about that and learn what to expect so that you can divorce yourself from getting caught up in that. And I think what we have on Elliott Wave International, elliottwave.com, is a great resource. And so I would highly recommend going there, poking around, seeing what we have, and if you have any questions, shoot us an email. And another thing is Conquer the Crash. Conquer the Crash is a outstanding book by Bob Prechter, detailing certain ways that the bear market is likely to unfold, and more importantly, ways that you can protect yourself. And that's the key to that book. Safe banks, some people to investigate, or services to investigate, that will help you navigate very difficult times. And so those are two really good resources that I would recommend people investigate.